Ever pondered how a political upheaval halfway across the globe can send your stocks tumbling? Or why a natural disaster in a distant land can cause your investments to soar? Welcome to the riveting world of global finance, where everything is more connected than you might think. It's a realm where the flutter of a butterfly's wings in one country can cause a tornado in the stock markets of another. And this, my friends, is no exaggeration. Imagine a line of dominoes standing on end, each one representing a different economy around the world. Now picture a single domino at one end tipping over. It knocks into the next, which knocks into the next, and so on. This is a simple yet effective way to visualize the domino effect in global finance. A political crisis in one country can lead to an economic downturn, causing investors to pull out their money. This sudden withdrawal can impact the stock markets, triggering a fall in stock prices. This, in turn, can influence investor sentiment in other countries, causing a ripple effect that can potentially lead to a global stock market decline. Similarly, a natural disaster in one region can disrupt supply chains, leading to a surge in commodity prices. This can boost the stocks of companies in related industries, causing a ripple effect that lifts stock markets in other countries. In both cases, the initial event is like the first domino that tips over, setting off a chain reaction that impacts economies and stock markets around the world. It's a complex, interconnected system, with each event having potential global implications. So the next time you glance at your portfolio and wonder why a specific stock is skyrocketing or plummeting, remember the dominoes, remember the butterfly effect, and remember that we're all part of a global economy where an event thousands of miles away can directly impact your investments. The world of finance is more interconnected than you might think, and a single event can set off a chain reaction that shakes up the global stock market. Global events come in many forms. Some, like economic reports, corporate earnings, and central bank decisions, are recurring and somewhat predictable. Now, let's dive into the world of economic reports. These are comprehensive assessments of a country's economic performance. They're like report cards for nations. And just like in school, everyone pays attention to the grades. When the United States announces a rise in GDP, for instance, it's a sign of a robust economy. This can lead to a bullish stock market as investors gain confidence and are more likely to invest. Then there are corporate earnings. These are the report cards for companies. When a company like Apple announces higher than expected earnings, it can trigger an increase in its stock price. Investors, always on the lookout for profitable ventures, may decide to buy more Apple shares, driving up the price even further. Lastly, we have central bank decisions. These are like the drumbeats to which the global financial orchestra plays. When the Federal Reserve in the United States decides to increase interest rates, it can cause a ripple effect. Borrowing becomes more expensive, companies may cut back on investments, and this may lead to a bearish stock market. But here's the kicker. Savvy investors don't just react to these events, they anticipate them. They stay informed, analyze trends, and make calculated decisions. They understand that a positive economic report might lead to a bullish market, that stellar corporate earnings can drive up stock prices, and that central bank decisions can cause market fluctuations. These regular events provide a sort of rhythm to the global stock market. But what happens when the rhythm is disrupted? Enter the disruptors, the unpredictable, the game changers, black swan events. These are the unexpected occurrences that send shockwaves through the financial world and drastically influence the stock market. Black swan events are rare, unforeseen incidents with extreme impacts. These events are outside the realm of regular expectations because nothing in the past can convincingly point to their possibility. Yet, when they do occur, they cause catastrophic consequences. Consider the dot-com bubble burst at the turn of the millennium. The internet was rapidly growing and investors were eager to cash in on the new digital frontier. But when the bubble burst, many internet-based companies went under, and the tech-heavy NASDAQ Composite Index fell by a staggering 78% from its peak. Fast forward to the global financial crisis in 2008. It was triggered by a downturn in the US housing market and subsequent fallout in the global banking sector. The crisis sent shockwaves around the world, wiping out trillions of dollars in wealth and leading to a severe international economic recession. And then we have the most recent black swan event, the COVID-19 pandemic, which needs no introduction. The virus's rapid spread and the subsequent lockdowns crippled global economies and sent stock markets into a tailspin. However, it's important to note that as disruptive as these events are, they are not entirely negative. Each of these crises has also presented unique opportunities for investors. For example, the dot-com bubble and the global financial crisis led to the emergence of new, stronger companies, while the COVID-19 pandemic has accelerated the digital transformation and created new investment opportunities in technology and healthcare sectors. These events are reminders of how quickly fortunes can change in the stock market. But with risk also comes opportunity. In the midst of chaos, there is also opportunity, a principle that holds true even in the volatile world of stock markets. When global events shake the financial world, they also create unique windows of opportunity for savvy investors. But how exactly can you turn a crisis into an opportunity? Let's take a look at some real-world examples. Following the burst of the dot-com bubble in the early 2000s, many investors saw their portfolios decimated. However, those who were able to identify the overvaluation of tech stocks before the crash and adjust their investments accordingly, not only survived but thrived in the aftermath. They understood that the inflated prices of these companies were not sustainable, and they acted on this knowledge. Or consider the global financial crisis of 2008. This event left many investors scrambling, but those who could see the bigger picture, who understood that the fundamentals of many solid companies remained unchanged despite the turmoil, were able to buy these stocks at a discount during the crash. When the market eventually recovered, these savvy investors reaped substantial rewards. The COVID-19 pandemic, a black swan event of a scale not seen in generations, also presented opportunities. Investors who anticipated the increased demand for digital services and remote work solutions were able to capitalize on this trend, investing in firms that provided these services and profiting from their subsequent growth. These examples underline a crucial point. Knowledge is power. The more informed you are about global events and their potential impact on the market, the better equipped you'll be to navigate through crises and capitalize on the opportunities they present. This is not about profiting from others' misfortunes, but rather about understanding market dynamics and making strategic decisions based on that understanding. In the stock market, every crisis can be a potential goldmine if navigated correctly. Remember, volatility is not necessarily a bad thing. It can be a catalyst for change, a chance to reassess and adapt your investment strategy, and ultimately, an opportunity to grow your portfolio. So, how can you as an investor keep a pulse on these global events and use them to your advantage? Firstly, staying informed is key. Develop a habit of reading reputable financial news sources daily. This doesn't mean you need to spend hours poring over every detail. Just a brief skim of the headlines can give you a sense of the market's mood and major happenings. Next, consider subscribing to newsletters or podcasts from financial experts. They can provide insights into how global events might impact the stock market and offer advice on how to respond. Remember, though, to always cross-check information and never make investment decisions based solely on one person's opinion. Now, understanding the potential impact of these events is crucial. This requires a basic knowledge of economics and how markets work. For instance, knowing that a rise in oil prices can affect industries such as airlines and manufacturing can help you anticipate market trends and make informed decisions. Additionally, consider using financial tools and apps that can alert you to significant global events and market changes. These can help you stay on top of developments and react quickly when necessary. It's also important to maintain a diversified portfolio. This means spreading your investments across different types of assets and sectors. When one area of the market is negatively impacted by a global event, another might be performing well, helping to balance out any losses. Finally, remember that investing is a long-term game. While it's important to stay informed and react to significant events, don't let daily market fluctuations dictate your strategy. Stay focused on your long-term financial goals and adjust your investments as needed. Knowledge is power, especially when it comes to investing. The more you know about global events and their impact on the stock market, the better positioned you'll be to make smart investment decisions. So there you have it, a glimpse into the complex and fascinating world of global events and their impact on the stock market. We've journeyed through the domino effect in global finance, understanding how regular global events and black swan occurrences can rock the financial boat. We've seen how crises can be turned into opportunities, with savvy investors capitalizing on market fluctuations. And we've stressed the importance of becoming an informed investor, one who understands and navigates these dynamics for success. The stock market is not an isolated entity. it ebbs and flows with the pulse of our interconnected world, influenced by international events, economic reports, corporate earnings, and decisions from central banks. Remember, the stock market isn't just about numbers and charts. It's a reflection of the world around us. So keep an eye on the world, and you'll be one step ahead in the game of investing. Don't forget to like this video and subscribe to our channel for more insightful content. Until next time, keep investing smartly.